In an unexpected twist, Tom Lee has sparked intrigue with his latest insights into the market's future. This isn't just speculation, it's a carefully crafted analysis that could change how investors view the coming months. Lee asserts that despite widespread fears of a hard landing, the current landscape might be setting the stage for a robust market rally. This perspective is not just an optimistic outlook but a well-founded argument that deserves attention. Lee emphasizes that the significance of the recent 50 basis points cut by the Federal Reserve transcends mere numbers. The market's reaction wasn't universally anticipated, reflecting a split sentiment on whether the cut would be 25 or 50 basis points. The fact that the Fed's decision tilted towards a more bullish stance rather than a hawkish approach indicates a potential shift that the market must absorb. This is crucial. Investors should pay close attention to this dovish tilt from the Fed as it suggests a positive catalyst for the markets. However, it's essential to navigate this landscape with caution. Lee warns that while the long-term outlook appears promising, the weeks ahead are likely to be turbulent. The stock market thrives on certainty, and with the impending uncertainty surrounding the upcoming election, we can expect some erratic behavior. The lack of clarity about who will occupy the White House for the next 4 years will create a volatile environment, and investors should be prepared for some roller coaster moments. In terms of positioning, Lee advises investors to focus on cyclical stocks, particularly in the industrials, financials, and small-cap sectors. These areas are more sensitive to interest rate cuts, making them prime candidates for growth as cheaper money flows into the economy. As interest rates decline, the cost of mortgages and loans will also drop, benefiting consumers and encouraging spending. This could lead to a cascading effect, revitalizing sectors that have been stagnant. Another critical point Lee raises is the relationship between GDP growth and inflation. He argues that real growth does not necessarily correlate with inflationary pressures. In fact, there are signs of an excess supply, particularly in housing, which could alleviate some inflation concerns. The primary drivers of inflation over the past 8 quarters have been shelter, rent, and auto insurance, all of which are showing signs of stabilization. With these factors in mind, inflation could be on a downward trend, creating a more favorable economic environment. While the short-term outlook may be rocky, Lee believes that a rally is on the horizon. Once the uncertainty of the election is resolved, the market could see a resurgence. Investors should look to position themselves in industries that are poised for success during this transition. Small caps, in particular, are expected to outperform due to their inherent sensitivity to lower interest rates. Lee also addresses concerns about rising unemployment numbers, suggesting that this is a temporary outcome of cautious corporate behavior. As the Fed signals a shift towards cheaper money, companies will likely become more aggressive in hiring. This means that the current unemployment statistics could soon reflect a healthier job market as businesses adapt to the new economic landscape. Ultimately, Lee's insights suggest that the recent Fed rate cut is a significant development that could lead to a brighter economic future. As rates move from 5.25% to an anticipated 3%, the implications for borrowing and spending are profound. This change could stimulate the economy, pushing consumers and businesses into a more optimistic outlook. In conclusion, while the current market environment is fraught with uncertainty, Tom Lee's analysis indicates that long-term investors should remain steadfast. Historically, the market tends to rally after rate cuts, especially when they are implemented thoughtfully and at the right time. For those looking to navigate this landscape, it's vital to focus on the fundamentals and stay the course. As always, don't forget to like, comment, and subscribe for more insightful analysis on the ever-changing world of finance.